The Bank of Canada holds the interest rate for the fourth consecutive time at 5%. The decision lines up with what was expected since inflation has cooled down from the high of 8.1% we saw in the summer of 2022. But what comes as a surprise about the bank's first decision of 2024 to maintain the rate is that the annual inflation rate was up to 3.4% in December last year, trending up from the November inflation rate of 3.1%. We'll have to wait until February 20th to find out how inflation is trending. 2.5 weeks after that, we'll see another policy rate decision on March 6th. Hey guys, welcome to my channel. My name is Fred Tam. I'm a real estate broker in Toronto, and I'm putting out new videos all the time to update you guys on what's happening with the real estate market and to give you the best tips to help you reach your real estate goals. If you're new here, hit subscribe to stay updated and make sure you watch to the very end because I've got my own prediction, which I based on actual market trends and analysis of when the rate will come down, and it's probably not what you're thinking. First, let's get back to one of the questions I wanted to address, which is why does the Bank of Canada's decision influence mortgage rate? So first, it's important to understand that the Bank of Canada doesn't set mortgage rate, but it does have some impact on them. The bank's decisions can influence mortgage rates because it directly controls what's called the overnight interest rate. Banks use the overnight rate like a benchmark for short-term interest rates, like mortgages. When the Bank of Canada raises the overnight rate, it becomes more expensive for the banks to borrow money. So they pass on these higher costs to consumers, including those who are getting mortgages. The overnight rate impacts the prime lending rate, which currently is 7.2%. The prime rate is always higher than the overnight rate that the Bank of Canada set. Changes in the prime rate impact variable mortgage rate. They'll usually take the prime rate and subtract a certain percentage to charge the borrower taking a variable mortgage. In fact, in November 2023, those who had variable mortgages saw their payments increase by an average of 70% compared to what they were paying in February 2022. So for example, if someone was paying $2,000 a month for variable mortgage rate, their payments would have gone up to about $3,400 a month. The prime rate at 7.2% is a big increase from the 5.95% rate that we saw in December 2022, and even a bigger increase from the 2.45% that we saw in December 2021. The overnight rate also impacts fixed rate mortgages. Whenever the Bank of Canada makes an announcement, it can impact longer-term interest rates, including those in the bond market affecting fixed rate mortgages. So this is why when the Bank of Canada kept increasing the rate last year in 2023, mortgage rates kept going up. This led to payments going up, and that's how the Bank of Canada influences mortgage rates. But how does the Bank of Canada and their decision on interest rate also impact the housing market? The Bank of Canada held its target for the overnight rate at 5% for a fourth consecutive meeting this month, leaving borrowing costs at a 22-year high. Because the Bank of Canada is able to influence mortgage rates, the housing market feels the impact since borrowing costs are higher. Canada's total population grew by nearly 1.1 million in 2023, which meant that for a lot of first-time home buyers or anyone really just buying a home would be finding it difficult if they were relying on a mortgage. In January 2022, mortgage rates were still pretty low. People were borrowing money at low interest rates, and that's fantastic. Although it eventually led to home prices going up because people had more money to spend. So throughout 2022, the Bank of Canada raised the interest rate from 0.25% to 4.25% by the end of the year. And in 2023, it went up to 5%, which is still where it stands today. As long as the policy rate remains high, the cost to borrow also remains high, and getting a mortgage becomes a bit more difficult. As a result, the real estate market slows down, there's less property switching hands, listings are staying on the market for much longer, rentals become more popular because homeownership becomes too expensive due to those higher borrowing costs, and we also see a rise in mortgage defaults, leading homeowners to sell by force, which is also known as power of sale. A power of sale happens when a borrower defaults on the loan, meaning they're missing their payments. And then legally, the lender would then be allowed to sell the property through the power of sale process. This can be done by auction or even listed on MLS. Now, one of the questions that everyone, including myself, is always wondering is, when will the rate go down? This is one that I'll tackle at the end of the video, so keep watching and I'll give you my best prediction on when the rate will go down. I analyzed the real estate market together with the trends of the Bank of Canada based on when inflation gets high and how they react to economic changes. And to figure this out, I also wanted to understand how long it typically takes the real estate market to react to certain changes. How long does it take for the market to adjust to rates going up or down? And also, how does it react when the rate stays the same? It's likely that a drop to the policy rate is going to happen this year, but the Bank of Canada will be patient while maintaining the 5% rate. Today, the rate hasn't changed ever since July 12, 2023, but let's go back to 2020. The policy rate was only 0.25%. In other words, compared to today, it costs almost nothing to get a mortgage. This caused a hot real estate market. Home prices were going up, buyers could afford to make offers on homes above their market values, and in many cases more than their original budgets, and sellers were obviously going to accept. And this hot market lasted for a long time. Let's go back a bit further. In 2015 to 2017, the policy rate was only 0.5%. The cost to borrow was extremely low at the time to get a mortgage. It took about 2 years for market values to reach new all-time highs. Remember this, 2 years before home prices eventually reached all-time highs. That's a dangerous thing. If you're thinking about inflation, then you're right. In that 2-year time frame, we saw that if the rate was held fairly low, it boosts the economy and gets people spending, which includes buying property. Some might have even purchased second or third properties, all thanks to the cost of borrowing being so low. This all happens when the rate trends down and remains low. But because of this, inflation was rising. So the government stepped in and raised the interest rate. Does any of this sound familiar yet? Just think about what's happening today. About a year later, by October 2018, the rate had gone up to 1.75%. During that time, real estate sales volumes came down, and so did market values of properties across the country. The bank held this rate until January 2020, and that's about 14 months. It took 14 months for inflation to come down to a level that was deemed to be under control, and that's when the Bank of Canada started to slowly bring the rate back down to where it eventually landed at 0.25%. This was back in March of 2020. Remember this one too. 14 months before the Bank of Canada started to bring down the policy rates. The Bank of Canada doesn't just wait for inflation to come down though. They wait for inflation to come down and see it maintained at a steady level before lowering the policy rate. And now up until more recently, when March 2022 came around, the Canadian economy was able to enjoy that 0.25% policy rate for 2 whole years. Does this also sound familiar? Just think back to 2015 to 2017, that 2-year period when the policy rate was 0.5%. So here are the trends that the Bank of Canada has been following ever since 2015. The Canadian economy gets to enjoy roughly 2 years of a low policy rate, and around that 2-year mark, inflation begins to go up. Then the bank steps in by increasing the policy rate. The rate goes up to whatever percentage it needs to get to in order to control inflation. Right now, that's 5%. About 14 months after upholding the interest rate increases is when inflation gets under control. That's when the Bank of Canada starts to gradually bring down interest rate. So now, just for fun, I'm also going to follow these trends to make my own prediction. Back in July 2023, the policy rate was raised to 5%. That's also where it still stands today after the announcement made today on January 24th, 2024. We know it takes about 14 months to see inflation come down after the policy rate is consecutively held for a period of time. This brings us to September of this year. This, by the way, coincidentally also lines up with one of the dates that the Bank of Canada will be announcing yet another decision on September 4th, 2024. It also lines up with the fall market, which is commonly known to be one of the stronger seasons for real estate sales volumes. But why do people move in the fall? Maybe people just like to move when the kids are back to school? If you can relate, you understand that summer can be busy with kids at home. So when we consider all of this, the 2-year period of low interest rates, the 14 months of consistent rates to keep inflation down before rates begin lowering, and even considering the seasonality trends in real estate with respect to the fall market, I guess what I'm saying is that by September 2024, that's when the Bank of Canada will likely begin to lower the policy rate. Is it an educated guess? Well, it's definitely not a shot in the dark, and it's certainly better than a random guess. Could it be sooner? Absolutely, especially if Canada is in recession territory, which could prompt a drop in policy rate much sooner than September. But what do you think? Let me know in the comments. We know the Bank of Canada will cut the policy rate when it wants to stimulate borrowing, spending, and investments. But I guess I shouldn't also be so optimistic and instead be more realistic. They'll increase the policy rate when they feel it's necessary to slow down an overheated economy. And realistically, more and more economists, investors, and various forecasts are suggesting the worst is over. Yes, the Bank of Canada is prepared to raise the policy rate further if they needed, and they say this to keep all of the options open, if not just to keep us guessing. Whenever the rate does change, and whatever it does end up going down to, they likely won't be as low as they were in 2021. If you're in the process of looking for a home this year, now is still a great time to get into the market. You'd be avoiding the competition that usually ends up pushing home prices up. The caveat is the high cost of borrowing, which is why many buyers are taking advantage of variable rates in anticipation that rates will go down in the next 1 to 5 years compared to what they are today. But the risk you take with timing the market and waiting for lower interest rates is that by that time, home prices will likely already be higher. Just do the math, or if you don't want to, check out the video in the card up top where I do the math for you. The next policy rate decision is on March 6th. By then, the Bank of Canada will also have the Consumer Price Index data of January on February 20th, which tells us how inflation is trending. There's already forecasts indicating that the rate will be held again during the next decision in March. If inflation is somewhere between that 1 to 3% that the bank is targeting, then we might see some positive change in the economy sooner than expected. Make sure you subscribe to the channel to stay updated. Thanks for watching.